We're being joined by Gaurav Mehta, the fund manager at Ambit Asset Management. Gaurav, hi, good afternoon. Thanks a lot for coming on board. Markets look fairly resilient first trading day rather of this fiscal. What is your view on the markets going forward? Do you believe that the worst is now over and markets would look up from here on?
Well, yes, I think, in the recent correction that you've seen, about 10% on the Nifty, about 15% on small caps and mid caps, and, much larger in certain stocks. I think overall that does provide attractive entry point for long-term investors, and specifically, because we believe that economy is recovering. Whether you look at auto sales number, you look at the IIP, I think a host of factors do seem to suggest that the economy is recovering. The yield curve is as steep as it has ever been over the last several years, which again is a leading indicator of the fact that you will see economic growth continue to strengthen from here on. And I think that will eventually reflect into corporate earnings coming through. And especially, yesterday was the first day of implementation of e-way bill. If that gets successfully implemented, then I think, a large part of the story of shift from unorganized to organized will start playing out. And I think that will affect a host of companies in the listed universe. So I think overall you are at a stage where both the economy as well as the earnings seem to be at an inflection point. And as that recovery comes through, I don't see a reason as to why markets should not do well on near-term valuations, on near-term earnings. Markets will look expensive, but the fact is that we haven't had any meaningful earnings growth over the last several years. If you look at a measure like a cyclically adjusted PE, where you look at a long-term normalized earnings base, then we aren't expensive. If anything, we are closer to long-term averages. So I think in a scenario where earnings growth does come through, we should trend higher. Whether we've already bottomed or not, I think is anybody's guess. But I do think that a large part of the correction is behind us, and and for long-term investors, these are very good entry points.
Sounds fair, and you've also fairly upbeat on the auto sales to continue going on, continue maintaining those high level strong demand as far as that is concerned. But as far as your sectoral bets is concerned, you have stated CV financiers. So tell us, why is it CV financiers and not CVs directly, or auto and companies directly that you would want to invest into, and what's the rationale for being more upbeat on CV financiers instead?
No, you're right. I think we're positive on the CV space in general, and to the extent that you are seeing strong signs of an economic recovery, commercial vehicles is a segment that should benefit. We've had about 3 odd years of sluggish numbers. I think now we're seeing signs of a turnaround in that sector, and I think that should continue going forward. Apart from the fact that the economy is recovering, you have the new scrappage policy. Obviously, that will also help. So, overall, that is a space that should do well. Obviously, we have some very good quality commercial vehicle financiers in the country, and they will disproportionately benefit as this recovery materializes. So, that's one of the reasons why we are positive on that space. And more importantly, in this scenario where yields in general are rising, I think CV financing is one space where you have relatively well-matched assets and liabilities in terms of duration gaps. And from that point of view, unlike many other NBFCs, for example, HFCs, we think will disproportionately be adversely impacted because of that rise in yields, because their assets are quite long-term in nature, their liabilities are relatively shorter-term in nature. But there is no such risk with commercial vehicle financiers, and with a recovery in their top lines and demand scenario, I think they should disproportionately benefit from here on. And more importantly, I don't think that at these valuations, any of these companies are very expensive. I think if anything, they are pretty attractively valued. So I think, which is why that's one space that we like from here on.
That's right. It makes sense, especially given the kind of strong recovery that we're seeing, macro triggers, improving infrastructure, e-way bill, a rural uptick, all of these factors clearly aiding CVs, and CV financiers also indirectly to be big beneficiaries of that. But you also said that you see strong earnings recovery, coming by. By when can we expect that? Because we've been talking about a recovery in earnings growth for a few months now, and now that the final and the fourth quarter is over, can we expect to see earnings recovery now? And what are the sectors that you would want us to look out for as far as good recovery is concerned?
Right. So, I mean, it's very difficult to time as to when exactly will that recovery materialize. But to the extent that you are finally seeing an EV bill implementation, and I'm sure that there must have been some channel stuffing from the unorganized sector ahead of this EV bill implementation. So, it's difficult to say whether the Jan to March quarter itself will show strong signs of earnings recovery or not. But I think it's increasingly becoming evident that April to June is a quarter that should be quite a robust quarter for corporate earnings, and that should be a quarter that should reflect the shift from unorganized sector to the organized sector. Apart from the segments which tend to be benefited from the shift from unorganized to organized, and I think those are the obvious ones. Consumer discretionary, I think, is a large beneficiary. Home building in general is a large beneficiary. So I think those two pockets very clearly should benefit from this shift. That apart, I think you are also seeing a strong sign of global economic recovery. So many of these outward-facing sectors, be it technology, be it pharmaceuticals, be it light industrial exports, be it specialty chemicals. I think those are again pockets that should see earnings recovery coming through. So I think broadly, as the economy materializes, pro-economic sectors both facing domestic economy as well as facing global economy should do well from here on, in our view.
Interestingly, you've mentioned home builders as one of your sectoral bets. Now, what are these sub-segments under that sector that you like particularly? There's so many, branches of it. There's cement, there's real estate, there's home improvement like paints, there's tiles and ceramics. What segment is that which particularly excites you?
Yeah, I think, if you look at sectors where there is a large proportion of unorganized, I think there are 3 or 4 sub-pockets that will stand out. So I think plywood is one, laminates is another, tiles is one, pipes is one, right? So tiles, pipes, and ply and laminates, I think those are the 3 key sub-segments where we think there is still a large proportion of unorganized sector, and where you will see this transition from unorganized to organized benefiting listed companies. So I think those would be the 3 key sub pockets of the home building material sector that investors should keep on their radar.
Hey Gaurav, great chatting with you and getting to know what Ambit is looking at from the sectoral point of view at this point in time, and your view on the market at large.